This is Scott Becker with the Becker Business Minute Podcast, the Becker Private Equity and Business Podcast. Today's topic is market allocation and asset allocation. One of the things that we've seen over the last couple of years is tremendous ups and downs in the market. So at the very start of COVID, the markets crashed. Then the next thing that happened is the Fed started to loosen its monetary policy. The federal government started to add trillions into the economy in terms of pandemic aid. This led the markets to spike back up. They went way back up. Third, last year, after 2021, 2022, the market came back down. 2023, and that happened essentially due to the Fed starting to tighten rates and move away from quantitative easing to what essentially is quantitative tightening. Started to raise rates, started to reduce their own balance sheet, sell their assets into the market, the treasuries they were holding. So then you're at 2023. 2023, the belief is that the Fed's almost done tightening rates, and thus the market went way up the first month of the year, the Nasdaq went up 12-15%. Then a couple alarming stats come in terms of inflation and jobs reports, and it leads people to believe again that the Fed is going to keep on working on tightening rates. This means that the market goes down. So what does all this mean for market allocation? What it means is as follows. When the markets go up and down, you start as an investor learn how much you could live with ups and downs in the market. The more that you could live with ups and downs in the market and play the long game, the more you can keep your exposure heavily focused on equities, figuring in the long run it's going to be okay. And then it's a whole different discussion, but we're big believers in index funds or very diversified portfolios of equities than betting on specific companies, which I think is really like gambling, and it's very hard to tell what's going to be great and what's not going to be great. But the more you could deal with these ups and downs and look at the long run, the more you can live with a heavy equity concentration. If in contrast, you're somebody who worries every time the market goes up and down, and I'm not embarrassed to say that I'm in that category. I can't help myself. I drink lots of coffee with the market all the time. I'm obsessed with it. I can't help it. But the more you're that kind of person, the more you better not have an allocation that's going to cause your heart rate and your blood pressure to peak up and peak down every time there's a big change in the market. And this leads you to understand what kind of allocation you could live with. So when I was a younger investor, I, in a short period of time, lost a lot of money in what was the original tech crash, the original dot-com crash. Many people, of course, don't remember that, but if you were around and you're my age, you remember the first dot-com crash. The benefit to me of the dot-com crash is it taught me I can't be 80 to 100% all in on equities because when they crash 20, 30, 40%, I can't live with that. And that's a great lesson. So for everybody out there, what I really suggest is you look at these ups and downs in the market. You probably talk to your financial advisor, your wealth manager, or if you do it yourself, you have a real discussion with yourself or whoever you talk to about these things and figure out what kind of allocation could I live with? How much ups and downs can I live with? The easiest way to study what different market allocations will mean in terms of ups and downs is probably through Vanguard tools online, but lots of people have these tools online that show what happens to a portfolio if it's weighted X% to equities to X% bonds when the market goes down, and how often that happens. So, for example, if your allocation is 10% equities and the market goes down 50%, you've really only lost 5% of your entire portfolio. But what happens with these allocation tools, they will show you over the course of 20 years, how often do you have a 1-year loss? How bad does that look? How often do you have a 5-year loss? How bad does that look? And how does your portfolio perform over 20, 30, 40 years? What you find is if you go with a more conservative portfolio, you have less ups and downs, but it performs less well than a portfolio that's heavily weighted towards equities. So in the long run, you do better with equities, but it's not what you could live with over the course of that long run, because the long run is only made up of lots of short runs. In any event, we view this situation of these ups and downs in the market last 4 years, a real world chance to evaluate how you adjust to and live with different ups and downs in the markets. And we think you shouldn't take it for granted. We think it could be a great learning experience for so many of us. Thank you for listening to the Becker Business Minute and the Becker Private Equity Podcast.